Buddy, right now, I want to let you know that we simulcast these online. So if you happen to not be able to make it, you can also sign up for the Zoom version. And even if you can't catch it live as we do it next month, you can watch a replay. When we're done recording it, we send all the people that are signed up for the virtual part, we send them a replay when we're done. Okay, so we do record this, and you can actually find it out on our YouTube channel. We post it out there too. So if you find this particularly helpful or any of the topics that we cover, you can go to our website and click on the little YouTube logo, go out to our YouTube channel, and then share the videos, the presentations that we do here. So, first of all, thank you for coming to Compass today. Here we are, middle of the year. Sneaks up on us every year, doesn't it? We're halfway through 2026. My name is Guy Lehman. I am an owner and advisor here at Compass Financial, and I am in charge of the educational event series that we put on for clients. So this week, today, we're talking about mid-year economic update and a little bit about the markets and what's going on there. Next month, we have niche insurance. Hold on here. Next month, niche insurances. And when I say niche insurances, it's all the little bits and bobs on insurances that people may not be familiar with. For instance, we're going to be talking about sewer and backup coverage on your homeowner's policy, which some of you may be familiar with because we had all those rains last week. So if your sewer backs up into your house, you may or may not have coverage for that. Okay, and we'll talk about these little niche insurances that you need to know about. We're also going to talk about cancer insurance, hospital stay insurance, right? AFLAC. That's what AFLAC is. We're going to talk about all these special insurances out there, whether they're worth it, how much they cost, and what they cover. And we're also going to talk about some fun ones like hole-in-one insurance, right? Think about that, okay? And then that's in August. And then September, Justin is bringing back our identity theft and fraud prevention. Okay. Huge these days. This is everywhere and affecting everybody. So that's a very important one. Justin is going to bring that back. We did it about 2 years ago. Okay. Just to introduce our team, we have advisors Justin Van Houten, Caleb Pearson's running our technology today, Alan Holstein, Michelle Bjorkren, Steve Connard, and Stephen Tallman. Our administrative staff is Julie Greer and Joe Waniger, Hannah Wilson, Cheryl Hurst, and Nancy Economist. So thank you. Today, we have, hold on. We have Jamie Rollette with First Trust, and he is going to talk. First Trust is an investment partner that we use, and we rely on them for a lot of their insights, and we are constantly checking against the investment professionals that we deal with to help us put good ideas into action and to make good decisions for our clients. So, Jamie, take it away.
Great. Thanks, Guy. Can everybody hear me? All right. Awesome. I'm glad to be here. So I'll introduce myself and my firm a little bit, and we'll get into it. I've got hours of prepared content, so buckle in. We're going to talk high-level economics. Originally, I'm from Decorah, Iowa, so I'm born and bred Iowan. Met my wife at University of Iowa, moved to Chicago for 6 or 7 years, and came back in 2010. Iowa City at the alma mater, and we've got 3 teenage kids. So for those of you that are just here to kind of the free food, I'm ignored with a bunch of teenagers in the house, no problem. But First Trust as a firm, as Guy mentioned, we're an asset manager based out of Chicago. We're privately held and we don't advertise. So we like to say that we're the largest asset manager firm, the largest financial firm that you've probably never heard of. And we choose to work directly with financial advisors as opposed to running commercials and putting billboards up in stadiums. So these are kind of the sweet spot of our business, is getting out and talking to folks. And so I'm really looking forward to doing this. And my job at the firm is I've got my own territory. It's all of Iowa and it's Kansas City. And I just cruise around down Interstate 80 and up and down 35 and meeting with financial advisors, meeting with clients, talking about the markets, helping educate the advisors on our products and where we think the market's going. And what I will tell you, just as an aside, is These events are getting more and more difficult for us to all put together. We're in a highly regulated industry. There's a lot of work that goes into this, a lot of compliance that goes into it too. So first off, let's do a round of applause for everybody that helped put this together and ordered the food and got it all going. Thanks for doing that. Definitely a team effort. And I would say, don't take it for granted that you're working with advisors that are doing these events, because they're getting less and less frequent. And I think they're getting more and more important based on everything that's going on in the world. And so do bear with me. In the beginning of the summer, I told my kids, they're ready to just play on their iPads and goof off. And I said, we're going to learn how to present. So I'm making them do PowerPoint presentations at the end of the summer. And I said, when I do my presentations this summer, you guys are going to help me build it, and you're going to be starring in the presentation. So I'm going to try to make my kids involved in a way that makes sense with the presentation, kind of so that I can give them a lesson. So get ready to be introduced to some of my kids. So when you look at this first slide, our firm puts this together. It's called Turns in the Road. It couldn't be more of a generic title of a slide. And you could use this at any point, because there's always turns in the road. We're always navigating through transitions. And clearly, I didn't put this together. This does not look like Iowa or Kansas City. So if I were to put the title on this presentation, I would call it Perspective. I think perspective is incredibly important. I think perspective is always something that we need to keep in mind, whether it's the financial world and our portfolios and the economy, or our personal lives. And we're arguing politics with people that used to be our friends and now we're unfollowing on Facebook. If we keep perspective and we remember that everybody sees the world in a different way, and everything that you see on the news can be interpreted multiple ways, then I think that's helpful. And so, speaking of perspective, I go to Kansas City a couple times a month. I'm down there a lot, and I always have people come up to me, and I'm going to see if you guys can guess what they say. They say, have anyone ever told you that you look like who? Thank you, Travis Kelce. I get it all the time. It makes me feel so good. I'm 46 years old. I've got teenage kids, and people are mistaking me for an NFL player. In case anyone didn't get it, I took that picture in Nashville and I sent it to my two daughters, who are big Taylor Swift fans. And so I figured we got to bring this up since it's the big wedding week. It was big news in my house. So there's Travis, and you can kind of tell that's probably the reason why I keep this ridiculous beard in the summer, because it makes me feel good when people say I look like Travis Kelce. But there was a time about a year ago that I was in Kansas City, and an older woman come up to me. I can tell by now the look that someone's going to say this when they come up to me. It's either a little kid that's really disappointed that I'm not Travis, or it's someone that wants to say something to me. And she comes up to me and she says, "Hey, are you Travis Kelce's dad?" I mean, talk about perspective. I thought I was going to get pumped up, and here, this guy's like 30 years older than me. And that really changed my way of looking at that. So just kind of a funny thing to think about how one word can change, how we feel about things. And so with the idea of perspective, when I put slides together and when we decide what to talk about, I always know the questions that you all are going to ask. It's just going to be whatever's in the news. And so now everyone wants to know what's going on with Iran, right? And what are going to be the market implications, because that's what the news is talking about, and that's what your friends and family are talking about. Did anyone ever tell you to stop worrying about Ukraine? But if I didn't bring that up, nobody else would have, because nobody's talking about it anymore, so we don't care. There was a period where Ukraine was all anyone was talking about. I did presentations last year in March and April, and the only thing anyone wanted to talk about was tariffs. Now, nobody wants to talk about tariffs, and I have to put it in the slide deck so that we can make sure that we talk about it. And so, yes, Iran is a big deal. Yes, we don't want to belittle or make light of wars, but what you can see in this slide is, if you take a step back and you look at in terms of perspective, we're generally always involved in some skirmish somewhere that would be a reason to get scared about our investments, or a reason to argue with people, or a reason to hate whoever's in the White House. And when you look at this dark blue line, the stock market returns have really pushed through all of these skirmishes. So again, it's not to say that it's not important. It's not to say that the Strait of Hormuz closing isn't going to have ramifications on the price of oil and the economy, but it would be to say that it's not like we've never been through something like this before. And again, maintain a cool head and understand that this will pass. If I come back next year, we'll be having three other things that you want to talk about. No one will ask about Iran because we'll have moved on to something else. Now, what I will tell you about wartime, is that the market does tend to go up. You can see in the blue line, the returns on every major conflict tends to be positive from a market standpoint. Not that that's our biggest concern when we're talking about a war, but the orange would tell you that the wars lead to more volatility than they used to. And you can see that if any of you, and I hope that you're not, to be honest with you, but if any of you are looking at the markets, you can see on a day-to-day basis what the news is saying, because sometimes the news is bad and the oil stocks are all up. Other days like today, the news is maybe a little better, all the oil stocks are down and everything else is up, right? And so it's just trading on news, it's trading on hope, it's trading on tweets or truths or whatever you call what Trump's on. Probably not as much fundamentals as it is emotions. And that's very typical of a wartime. For those of you that want to know, when are we going to be done? I think our firm's answer would be it's probably going to take a little while. For any of you that are historians, you know that Persia has not typically surrendered very often. They've never been defeated, and they clearly aren't super interested in wrapping this up. So what we would anticipate would be continued volatility, a lot of up and down, a lot of saber rattling, and probably a solution that's a little further off than most of us would expect. But you never know. Things change every day. So I would expect to live with a little bit more volatility. That being said, it's also not just the war piece where we get all wrapped up in the news. It's really kind of everything else. And so what we like about this chart that we put together is this is showing us everything else that's going on in the world at any given point, or has gone on in the world, where it seemed like the most important thing. And the fact that, again, in the blue, the stock market, historically speaking, does kind of shrug it off. We've gotten through everything that this country's ever seen, and it's now 250-year history. We believe that we'll get through this as well, and that you want to go and be invested in America, bet on America. It's been a winning bet. We think it's going to be a winning bet in the future. So as a firm, we're very optimistic on the future of this country. That being said, I will show you some things throughout the course of this presentation that we are worried about, because there's always things to be keeping an eye on and keeping, as the title of the slide suggests, perspective. So to take a pause and just give you a couple of pieces of recommendations that I would give based on now 23 years in this industry, there's two of the most important things for individual investors to always have on your side. The first one is a financial advisor. I'm biased. My father is a financial advisor. He's my financial advisor. That's why I do the job that I do, is because I really believe in the advice that these folks are giving you, the time that they put in, the care that they take in your families and your financial futures. Definitely always have a financial advisor. When we get to all-time highs, we all get confident. We think we can do it ourselves. Trust me, we can't. You need somebody there to help you, especially when times get difficult. The other thing that you want on your side is time. So let's look at this chart. If you, on the left, look at the market for one day, 53, 54% of the time the market's up. It's basically a coin flip. I would encourage you not to invest for a day. But the likelihood of a positive return increases the longer that you stay invested. And so if you can give the stock market 10 years, there's a 97.5% chance that you're going to finish positive. And the reason that it's not 100 is because there was a little sliver of time for 10 years in 2008 where the market was negative for 10 years, and then 2009 came and it got back to positive again. So it's almost 100, except for that one time, which I'm sure 2008, most of us remember, was definitely, as we say, unprecedented in our business. So time and financial advisors, those are the two most important things. Everything else we're going to discuss is secondary. Speaking of time and speaking of the maybe emotional piece of the markets, right? One thing that's interesting, if you look at this chart, and I know it's probably a little tougher for you in the back to kind of see what's going on here, but there's bull markets and there's bear markets, right? The bull markets are when the market's up. The story that my dad always told me when I was a kid is if you get hit by a bull, it hits you and then it lifts you up, right? That's how you know it's a bull. And then what happens when a bear hits you? It hits you with its paw and it knocks you down, right? So the blue are the bull markets. What do we notice about the blue? lot more blue on the screen than orange, right? They last for a long time, and they tend to be much more substantial in size than the orange. So would any of you agree with me that this dinky little orange part, which was 2008, is more memorable and more visceral than any of the blue? That's the challenge of this, right? If there wasn't the orange, then the blue wouldn't be as good because the orange ones wash out people that can't handle tough times. Now, the tough times are way shorter and they're less substantial, but they feel a lot more powerful and we remember them and it clouds decisions. It's another reason why, we want to be working with an advisor that keeps this in mind. It's also why we want to remember that time is our other piece that we want to keep in our mind. So I think those are just good, again, perspective slides for us to keep in mind. This is something that a lot of people aren't aware of. Market concentration. What does that mean? This chart is showing you, going back into the 80s, what percentage of the S&P 500, which in our business we just call the market or kind of use it as a proxy for the economy, what percentage of the S&P 500 are the 5 largest stocks? And it's okay if you don't know this because most people don't. The S&P 500 is weighted based on size. So the larger the company, the larger the weighting in the S&P 500. And the bigger the larger companies get, the more heavily weighted they are on the market. And so when you have a company like NVIDIA or Apple or Amazon, those have a much more important bearing on how the market performs than some of the smaller companies, even though they're both in the same index, right? And so we are right now looking at about 25%, call it 23% of the S&P 500 in 5 stocks. Did anybody know that? If you're invested in the S&P 500, a quarter of your money goes to 5 names. If you expand it to 10, it's about 35%. So a third of the S&P is 10 stocks. Now, if you look at those 10, and a couple of weeks ago, I was telling people that Eli Lilly and Micron were 10 and 11. And they're going back and forth. So depending on the day, all 10 were technology companies. Sometimes Eli Lilly would jump up and other times it would go down. Well, Micron's up 7% today, so I'm comfortable saying that all the 10 largest stocks, 35% of the S&P, all technology. Now, we're Iowans. We tend to be, let's say, more conservative financially than almost the rest of the country as a whole. We also don't tend to need all those huge returns that some of these big tech companies give us. So it's probably not a great idea for us to be invested just in the S&P 500 with such a massive overweight to technology, because anyone that had stocks in the late 90s remember that when technology goes bad, it can go really bad. Now, when it goes well, it goes incredibly well. So we want exposure, might not be something that we want tremendous exposure on. And if we let history be our guide, the last time that we can kind of see a market that was like that was back here in 2000. And I don't mean to scare you. There's a lot of differences between 2000 and now. But 17% of the S&P 500 were 5 stocks. And those 5 stocks are down on the bottom left: Microsoft, GE, Cisco, Walmart, ExxonMobil. So put yourself back in 2000 and you would have thought, man, these companies are massive. There's no way that those aren't going to be the biggest companies going forward. But that 17% of the 5 largest companies, fast forward to today, are only 8% of the S&P 500. Other companies have come and overtaken them. And most of these companies that have overtaken them didn't even exist in 2000. So to answer the question on who will overtake these in 10 or 20 years, the answer is probably they don't even exist yet. And so it's something that we always want to keep in mind. Microsoft is actually the only one in the top 5 that has managed to stay in the top 5, but it's been knocked down to number 4. So something to keep in mind. I think Exxon is really interesting too. Exxon was 2.26% of the S&P in 2000. The whole energy sector put together is less than 3% of the S&P 500. The whole energy sector. So that tells you that NVIDIA by itself is like 2.5 times the whole energy business of the whole country. So that tells you, kind of the size and scope of some of these massive companies. So it's something, again, that helps to have this. have an advisor to help us steer through these waters. So this last part is a little bit kind of tough to understand at first until you start thinking about it. This would be talking about breadth. The way that you would get 5 companies to be that heavily weighted in the S&P 500 is just a few companies crushing it and the rest of them not doing as well. So this is a measure of the percentage of companies that in a given year outperform the S&P 500. Now, intuitively, we would think it would be 50%, right? Because it's an average. Half the companies would do worse than the index and the other half would do better. But remember, it's weighted by size. So if those big companies do really well, then you've got a few companies that are dominating and the rest of them are underperforming the average. And so if you look at these oranges, starting in 2017, for pretty much the whole decade, we've had less than half of the S&P 500 outperforming. And here recently, it's been less than a third. So the performance has been very concentrated on these few stocks. So if you've got a couple of your friends that say, oh my gosh, I'm crushing it. I own, NVIDIA or Palantir and I'm up, millions of dollars. They got lucky and they picked the right stocks that have done really well. We are expecting that this will start to broaden out. That some of these big gains that some of these large companies have had over the years will start to kind of give way to some of the more traditional stocks, and that some things maybe that you've owned for a while that you've looked at your account and says, what the heck is going on with this company? It's not doing anything. We think that that's going to really change. And that was starting to happen before the Iran war. And we think once things get a little bit cooled down, that will go back to a more broad, more healthy economy. And that will be good for the markets. So good point to pivot to my 2 girls. I have a 14-year-old daughter, Lily. This is a couple years ago, but she's a swimmer. She's a sweetheart. She likes nobody better in the world than me. I know you're not supposed to say you've got a favorite, and I won't say that I have a favorite, but, my oldest, probably my favorite. This is my youngest. She is an insane, wild person, potentially a cult leader. You can tell by that face. Hey, give me your best face. This is daddy-daughter dance. I'd love to have a great picture with you, and that's the best one that I've got. Now, the interesting part is these are 2 girls living in the same house, raised by the same parents. They could not be any more different, which is essentially what's going on the political spectrum, right? We say my daughter's nuts, but she thinks she's acting normal. That, I would say, is something that for the next portion we want to keep in mind. When I talk about tariffs, and whatever I say, it's not pro-Trump, it's not negative Trump. Usually when someone starts to talk about things that smell like politics, what we want to see is something that verifies what we think, not new information that might help us change our opinion. So that's my way of saying, hey, if you lean one side, you lean the other side. Remember, it's just 2 different perspectives, just like my nice girl, my crazy girl. So tariffs, when you look at it over the course of our country, we will say, oh my gosh, we're seeing unprecedented tariffs. These are not unprecedented tariffs. This is unprecedented. The fact that we went so long without any tariffs, and then all of a sudden they came out of nowhere. They represented 3.7% of the federal receipts. But here in February, the Supreme Court struck down tariffs. They basically said a tariff is a tax. The taxation in this country goes to the Congress. And so we're not worried about tariffs anymore. So all that sleep that we lost, all those times that we thought we should sell all of our stocks because the tariffs were going to be crazy, now you've all forgotten about them and they kind of don't matter. This will probably take years and years to go back through the courts, and they'll figure it out. And I think if Trump's behavior has told us anything, it's that he uses tariffs as leverage. He's just going to find another area to use leverage on countries, right? It might be defense, it might be business deals, whatever it is. So I don't think that the tariff situation changes very much because these are the rates. So it doesn't matter if you look at the money that we brought in or the tariff rates. With the scope of history, it wasn't that big of a deal, and it wasn't something that we'd never seen before, and we've pushed through it. And I think that you're going to see a lot of that happening going forward. The other part of the tariffs that I like to kind of use as a way to dovetail into inflation, because that is something that is probably a concept that we should spend some time on and that we should really be thinking about. So the orange line is inflation. This is Trump's first administration, right? And most people forget that tariffs were a big topic of conversation during Trump 1, right? Specifically to China. He implemented tariffs on China. And the idea was this is going to lead to this massive bump in inflation. But if you look over on the left, the inflation rate, while it did move around, because it always moves around, it basically landed on the same inflation rate as when tariffs started. So, and it's anecdotal, but we would say that tariffs really didn't have a whole lot of impact on the inflation rate. Now, you're going to say, well, I know that we have had massive inflation, and it feels like every time I go try to buy a steak at Hy-Vee, that there's a lot of inflation. The inflation kind of started right here, which is November of 20. January of 20. Does anyone remember what happened first quarter of 2020? Yeah, we want to forget, right? You can't forget. It was COVID. So that's kind of where we're going to start with the inflation story. Is first off, what is it? Well, what people think inflation is prices going up. The better way to think about it is your dollar buying less, right? Same dollars, and if you haven't invested in something that grows, you have the same dollars. It's just your dollar buys less steak, less pizza, less gas. So it's really a dwindling of the purchasing power, and prices just go up to reflect the fact that the purchasing power has gone down. So it's better to think about inflation as dollars versus prices. Now, any of you that have ever taken a business class, the first day of economics, they teach you about inflation, they give you a definition. Does anyone want to take a stab at it? All right, I'll tell you. It's too many dollars chasing too few goods, right? There's a lot of money, there's not a lot of goods, so what happens? The prices of the goods go up, right? If there's too many dollars chasing not a lot of houses, what happens to housing prices? They go way up, and we say housing prices are inflated. Well, it might be we just don't have enough houses, and that's usually what happens. Is there's a rationale behind the reason. Now, if we think about COVID, what happened? We printed off a ton of money, and we shut down all of our businesses. So there's too few goods, and there was too much money. So we were pulling the levers on both sides of the inflation problem. So it shouldn't be a surprise to anybody that we had a lot of inflation during COVID, because we shut the economy down and we put money literally into people's checking accounts. Shocking number, but 75 cents out of every dollar that we all have were printed off in the last decade. Think about that. 75 cents of every dollar was printed off in the last decade. And that takes the economy a long time to unwind. So we are likely going to see higher prices for various things for a long period of time. And then when you have something like a war where, think again, too few goods, the Strait of Hormuz closes and there's a supply crunch, the dollars are going to respond to that lack of goods, and it's going to push the prices up, but it's just our dollars buying less gas. So that's kind of where we want to look at what causes inflation, why does it stick around, how might we be able to fix it? If you look at where it shows up most frequently, so think about hospital services or healthcare, college tuition, preschool, medical services, housing, wages. Can anyone think of what those have in common? There's a lot of government intervention, right, with those areas. College tuition, you've got student loans that maybe is kind of an artificial market. Hospital services, we've got Medicare and insurance. They're not pure markets. When you look at things that are pure markets, we actually see deflation. TVs, anybody remember those humongous TVs in the 80s and 90s, like this big, and they had nice wood all over them, and they were like a fixture of a living room? And now they're massive, and they weigh 3 pounds, and they cost nothing, and you just throw them away when you're done with them. That's the pure market working. And so it's toys, it's software, it's cell phones, household appliances. So the more that the government gets involved, the more the prices tend to go up, because it takes a pure market and it makes it not as pure. So unfortunately, that's kind of going to be the answer to the inflation, is that the fixes usually exacerbate the problems, where if we would let the market take care of itself, the problems would be significantly less. That's our firm's view, and so you can take that with a grain of salt. Let's go to this one. I think this is an opportunistic view on inflation. The best way to fight inflation is to invest in something that outpaces inflation, and that's going to be stocks at least as a portion of your portfolio. If we go into a period with a lot of inflation, if you want to invest in corn futures or something, you can do that. But the best way to do it is to have some sort of exposure to equities in your portfolio, even very conservative ones, over time will lead you to outperform inflation. And if that's a key worry to you, you will make up the difference in the market. So that's one way. Now, let's talk about the Fed. And the Fed is a tough one because we really shouldn't spend as much time on it as we do. Interest rates, I mean, think about it this way. Our chief economist, who this piece that's in front of you, he writes every Monday. Our website is right on the top. There's no logins or passwords to get this. You guys can all get this every week, ftportfolios.com. On the left-hand side of the website, there's a couple of guys in suits. You click on Brian Westbury's face, you get the Monday Morning Outlook. It goes all the way back to like 2005, so you can go see what we were talking about in 2008 and COVID and all that stuff. He put it, I think, a really nice way. The new iPhone comes out in September, October. I'm forgetting. I think it's September. Let's think about Apple's board meeting, and they're talking about the new iPhone, and they're all the new things it's going to do. What are we going to charge for it? How are we going to come out with it? When's the release date? How much time in that board meeting do you think they spend talking about where interest rates are going to go? Well, we got to think about this iPhone, but what's the Fed going to do? Zero. They don't care. They're going to come out with that iPhone regardless of what happens with interest rates. But we are all so focused, especially in our business, on where are rates going? What are bonds going to do if interest rates go up? It's really not the biggest deal. But if you look at this piece, I think there's a couple of really nice points that we're making on this with a new Fed chairman. The first one, unfortunately, is that a new Fed chairman can only do so much because they still run this by a vote. And unfortunately, like everything else in our world, it's very political. And the former Fed chair is still on the Fed, and he's still very politically connected. And so this idea that there's a new sheriff in town and we're going to see a massive new Fed policy and rates aren't going to be politicized is probably not the case, right? It's probably more of the same, as, at least until the midterms. Secondly, though, one thing that we are excited about is the new Fed chairman, Kevin Warsh, does seem to be trying to make the economy less dependent on the Fed. Some of the previous Feds that we have had have kind of acted like, hey, let's see what the market will do if we do this. And what he is saying is, let's respond to what's going on in the market and in the economy, and then we respond to the economy as opposed to vice versa. And that does kind of mean that the Fed's influence should shrink. We think that's a good thing because we would much rather see the Fed responding to the market as opposed to the market responding to the Fed. And so if you think about inflation and what the Fed might do, because the next question is, are they going to raise or are they going to cut? Well, typically, when we see this little bump up in inflation, the Fed will usually raise rates to try to slow the growth down. But in our opinion, and this usually isn't where we land, but in our opinion, this is because of the war. And you're also seeing, with inflation ticking up a little bit, the savings rate going down a little bit temporarily, which tells us that consumers are taking savings, using it to offset oil. And so a raise in rates and a cooling of the economy would hurt because the savings rate is down. So we think that that will come down, and we're much more likely to have a flat interest rate policy as opposed to a cut or a raise. It's very hard to cut rates when inflation is up a little bit, even though that's what Trump wants. But we think raising would be a mistake because of the fact that that savings rate is down a little bit. So if anyone has any questions, we can kind of do that at the end. But if I can introduce you to my son, because I promised you I'd cover all three of them. This is my 13-year-old son. You can see his crazy long hair. People either say he looks like a 1970s tennis player or one of the lost members of the Allman Brothers. He's had this hair since COVID. We'll never cut it, loves it. And I came back from Kansas City 2 weeks ago to a brand new kid. So much like your kid's hair, if the Fed cuts by surprise, it's entirely possible. I never thought I would see my son with short hair. It's like a whole different kid. So I take all the Fed stuff and just understand that we're guessing just like everybody else. It's probably the one part, wouldn't you all agree, in our business that's impossible to predict is even what direction the Fed's going to go, let alone how they're going to do it. So I'll try to kind of wrap some of this stuff up and we'll get to Q&A. In terms of stocks, again, if you give it enough time, cuts, raises, the market tends to go up. So this is length of time, and this is performance of various periods where the Fed has cut rates, and the market by and large has been up every time they've cut rates. But given enough time, they've been up every time they've raised rates. And usually people will say rising rates is a bad time for stocks, but clearly that's not the case. It just kind of changes what types of stocks we tend to buy. So the smaller companies do a little bit better when rates go up. So we're prepared for cuts or raises, and neither one would make us bullish or bearish. Okay, so couple of things in terms of spending, because I know that was on the list. That's probably something that you all want to talk about, is debt and spending. This is probably the biggest problem that we have with the economy. People will say, what keeps your firm up at night? It's the growing size of the government. And so what you're looking at here are receipts. So basically, how much are we bringing in, taxes, tariffs, and otherwise, and spending. And the spending is outpacing the receipts. One way to do it depends on who you listen to, would be to try to raise this, but it's already going up and the problem's only getting worse. So I think the better answer is probably bring the blue line down. The problem is, it doesn't matter who gets in the White House, Congress, or the Senate, none of them seem interested in cutting spending. So that probably means more volatility, and it probably means that we're going to continue to have some sort of fiscal issues because nobody seems incentivized to cut any of the spending. And when you break it down in terms of where the government spends all their money, and we look at the purple. The purple is what everyone wants to talk about, is all this interest that we're paying, and it certainly is massive. We've clipped over $1 trillion annually just to pay the interest on the debt. But all the rest of the spending is pretty well required, right? We have to spend on defense. We've got subsidies, we've got Medicare, we've got Social Security. So I know there's a hot button issue. We believe that at some point we're going to be faced with the inevitability of having to change Social Security benefits, Medicare benefits. Likely it's going to be means testing, which means, the people that have higher wealth or income, or however they measure it, probably have some sort of cut or elimination in some of their benefits. These are probably more than a decade off. It's an issue nobody wants to touch. It's the guaranteed way to lose an election. So it probably means that, we're talking about stuff that's way further into the future than is even merits worrying about. But I know that someone will ask about this. And so the size of government is definitely something that we think is an issue. And this would kind of show you the same concept, which is the spending as a percentage of GDP is the issue. The GDP is kind of chugging along on average. Like, we're in a decent economy where we should be. Spending keeps going. There's only two ways to fix this. It would be to cut spending or to figure out a way to massively grow the GDP. And the one potential bailout would be AI. If AI rapidly increases how much we can do and with fewer assets and fewer amount of time, there's a chance that we can outgrow the fiscal issues. So if somebody's looking for a silver lining, I know AI, at last I checked, was 75% negative favorability in the country, but it would be that kind of golden bullet that we might be able to get out of some of these fiscal problems. Would just be we grow like crazy for a decade because of AI. And then the other nice part about it is that if you look at hourly earnings, we are earning more than prices are going up, which is a good thing. It's something that we don't talk about a lot. Everyone just, the prices are going up and everything stinks. But it's good to see that hourly earnings are outpacing inflation. That does mean that it's a sustainable economy. And I think this is kind of fun because think about COVID, and everyone groaned when I talked about COVID, but the amount of new businesses that were started during COVID was massive, right? Because everyone was at their house and didn't have anything to do. And they said, yeah, I'm going to start a podcast, or I'm going to do, whatever, a YouTube channel, or I'm going to start, selling crochet out of my garage. And you would think that when everybody went back to work, that those new business applications would have fallen off a cliff because they went back to their old businesses, but it's actually going up. And I think that is one thing that you can see that AI is doing that's a substantial change, is it's taking a lot of the resistance away from people doing something different. They can start a business because they don't need 10 lawyers, because they can do it all on ChatGPT. So look for that as a nice indication. If people are starting to do interesting things, they're doing it cheaper, they're doing it faster. AI is definitely allowing them to do that. So not to say that everything about AI is great or that there's nothing to worry about, but there are definitely some economic benefits that we're seeing at our firm. Okay, so we'll end with a guessing game, and then I'll bring Guy up first, and then Q&A, or do you want Q&A first? Perfect. All right. Who am I? I do commercials for State Farm, and I have my own cereal at Hy-Vee. Wrong. I told you guys I spend a lot of time in Kansas City. The answer is Patrick Mahomes. This is perspective, because when I'm in Kansas City and I give the same presentation, I tell them that they're wrong because they all guess Patrick Mahomes, and I tell them it's Caitlin Clark. Again, perspective is different. Just because you see things one way doesn't mean it's right, doesn't mean the other person's wrong. Those are both correct answers. And we'll skip the politics part. We'll do this one, and then we'll wrap. Any golfers? Justin in the back, that's it? All right, Justin, what shot is this that you're looking at on the left? The most famous shot in golf. 18th hole of the Masters, Augusta National. If you can see how little that shoot is and all those people that are really brave that are standing there, that's a knee knocker. It's a hard shot, and investing can sometimes feel like that. The 18th at Augusta, everything's on the line and you don't know what to do. Topgolf is much different. If you slice this shot, you don't hit anybody, you hit the net, who cares? You can technically get over the net. I have seen someone do that, but it's pretty tough. We would like to make that easier. We would like to make the markets more like the net with the nets at Topgolf than the 18th at Augusta. And just know that the advisors in the room are using products at First Trust that are de-risking the markets. It's putting nets over the equities. So there are ways for you to be in the markets, but nullify the downside risk. And this is something that all these guys have been really on the forefront of. And I think that's important when you're dealing with all of us in Iowa, because we generally are more conservative. And so we'll skip through this part and I'll just close it out. We talk about Caitlin Clark. Anybody know what this picture is? This is Caitlin Clark breaking the record as the all-time leading scorer in women's basketball. 99.99% of people would say that. In my house, it's a lesson of why you want to be the nice daughter and not the mean daughter, because that's me. And on the left is my nice daughter, and the mean one, I left her at home. So again, perspective, that was a fun thing to see. And I know being a local girl, I figured you guys would appreciate finishing up that way. So I'll turn it over to Guy. Any questions you have, we'll come up together.
All right, thank you. All right.
Thank you.
Yeah. So a few comments. Caleb, you want to go back a screen or two? A few comments that I heard Jamie talk about that I want to comment on. The Strait of Hormuz being closed. Well, I ran into a great quote from an engineer that said, Guy, constraint is the mother of all invention. So what do we have in the Strait of Hormuz? A constraint, right? Can't get oil through there, can't get ships through there, can't get goods through there. Believe me, there is an explosion in ideas and ways that Middle Eastern countries are now transporting oil that are not through the Strait of Hormuz. Pipelines, rails, trucks, who knows what is going on. So there's an explosion of engineering, creativeness, human ingenuity going on to solve problems that are showing up as constraints in our world right now. That's just one example. Secondly, spending. People ask me a lot about the spending. Hey, when we go back to the chart about we're spending more than we're bringing in, right? There is an example for us out there, and it's called Europe. Europe has been down this path decades before us. And so if we stay on this path, where does it lead us? It leads us to a European economy. What does that mean? That means much slower growth than we're currently experiencing, higher taxes than we're currently experiencing. Okay, that's where a lot of debt, it constrains your growth as a country. Okay, so that's where we're headed if nothing changes. Let that be on your mind as you're voting for people. Okay, Inflation. You saw inflation numbers, right? Those are official government inflation numbers. Okay. I read an article. Now, the official government inflation numbers has all sorts of adjustments to it. And one of the adjustments is one item in there, right? Because it's looking at a whole basket of items that we consume and use and pay for. When one item in there gets too expensive, you know what they assume? That we will substitute that expensive item for a less expensive alternative. And there's a group of people that went back and did a study that tracked everything. They didn't make those adjustments. They said, hey, what if you keep buying the new piece of technology? What if you keep buying the same steak that you always bought, you know? And they tracked over the last 25 years, inflation has actually been at 4% versus the headline number that we're given by the government is a little over 2. Okay, so in reality, maybe we're experiencing higher inflation than what the government tells us. That's a distinct possibility. And in fact, the government itself has an incentive to keep that number low. Why? Because inflation helps instruct the interest rate policy, and the interest rate is what we're paying on our national debt. Okay, so if you're paying debt based on an interest rate that another part of you sets, the whole idea is to keep it down. Plus, keep it down because we give Social Security raises based on that amount too. And we all know that Social Security raises in the range of about 2% are not keeping up with inflation generally. Okay, so just a couple comments about that, about just somebody who steps back and kind of looks at the whole picture and says, you know, maybe that doesn't make sense. So always be checking about where this data comes from. Okay, as usual, I go back through some local stuff. And we've talked to an accountant, talked to real estate people, talked to banking people, and got a quick economic update for local things in Iowa. So here's your tax update. Now, not much changed in 2026 as far as taxes goes. And the reason is because the big beautiful bill was passed in 2025. So a lot of changes happened last year and applied to last year that, of course, it's the same this year as it was last year. The big change was the state and local income tax deductibility. Used to be, so on your state property taxes, state income taxes, and local taxes, you used to be limited to $10,000 deducting that. Okay, that has been expanded now this year in 2026 to $40,000. And there used to be no limit, right? 5 years ago, there was no limit. It got limited to 10. Now it's been expanded to 40. But again, based on your income, that can be whittled back down to 10 if you have high incomes. But it allows more people to potentially itemize on their taxes than take the standard deduction. Although the standard deduction is quite high for most people, $30,000 for a married couple, maybe even up to $37,000 or $38,000. So that's a pretty big hurdle to clear, but that's been a big change. All the solar credits are gone. All the electric vehicle credits are gone now. And in addition, those that do choose the standard deduction can get an additional small charitable deduction of $1,000 or $2,000. But you have to give more. There's a AGI hurdle. There's a gross income hurdle that you have to give at least 0.5% of your gross income to claim that little additional deduction. In the past, charitable contributions could only be itemized, but again, there's that little give back where somebody who does a standard deduction might also be able to have a small charitable deduction on their taxes. Iowa, most of the Iowa laws are dovetailed with the federal laws. So if something changes on the federal side, it changes on the Iowa side, like standard deduction amounts and things like that. Gift exclusions. So you can give any person, related or not, $19,000 a year with no reporting in 2026. Okay. Again, as in the past, most retirement income is tax-free in Iowa. And here's a little thing that the CPA said a lot of people miss. If you inherit retirement assets, typically, right, if your parent was having to take money out and you inherit their pre-tax account, if who you inherited it from was subject to the 0% state tax on retirement income, then the person who inherits it is also subject to 0% state tax on that retirement income. Okay, so that's something that's missed a lot. Okay, on to general business environment. The Des Moines Metro, which population has now exceeded 800,000, and that includes, right, Des Moines and all the surrounding communities, with a growth rate of about 3%, has 14% lower costs than average to begin a business. And therefore, we see a lot of Des Moines Metro showing up on national top 10 lists as great places to start businesses. Generation Z loves amenities and is really attracted to less than a 20-minute average commute in the Des Moines Metro. So again, affordability, ease to get around, amenities that we have here in the Des Moines Metro are really attractive to the younger generation. So we're growing faster than average. Okay, on to residential real estate. 2026 so far is a much more balanced market between buyers and sellers than we've had in quite a while, right? Up until about last year at this time, sellers had the upper hand, right? Because prices have gone up. And now it's quite balanced. Many people are locked in by lower interest rates when they finance their houses in 2020, 2021, and 2022. Okay, so they don't feel like they have the flexibility of selling a house and upgrading because they have a 2.5% interest rate on their 30-year mortgage. So because of that, we generally see less activity than we have in the last 3 to 6 years. So there's less activity, less buying and selling going on now in the Des Moines Metro than we saw 3 to 6 years ago because of that locked-in effect. Houses are sitting on the market longer. Right now it's 75 days, which on average, which is the highest since 2019. The lower price points, so under $300,000, of course, move more quickly because there's a lot more demand for those types of starter houses. Cash purchases make up about 15% of overall sales, and cash purchases typically come from investors. New construction makes up 44% of the total inventory of houses for sale. And right now there are about, I think, 4,400 houses for sale, which is the most since 2019. Okay. And the general rule in real estate that has applied to the Des Moines Metro for a long time now, probably 10 years, is if your house does not sell in the first 7 to 10 days, on average, it'll be on the market for 6 months. Okay. That's the general rule, which means that you got to price your house right to begin with if you're a seller. Okay. If it lands with a thud, it's going to be for sale a while, and then you're trying to make adjustments over time. Okay, banking health. Banking health is strong. Loan activity is actually down 4% from last year. So I would say general banking health is strong. Loan delinquencies are very, very low at about 0.5%. Assets, that's how banks measure their size and strength, are generally flat over the last 12 months. There have been several mid-size multi-location banks that have been bought in Iowa. That means someone else coming in from the outside and buying Iowa banks. So there's been some consolidation. Two Rivers is an example. Midwest One is an example. Iowa Savings Bank. And these are banks that have local branches, but have many branches across Iowa. And ag is actually a stress area for banks. I'm going to talk about the ag economy here because it's such a big deal for us in Iowa. So the ag economy is generally under stress. I will say the crop farmers, corn and soybean farmers, are on their third year of unprofitability, lining up for 2026. So 24 was bad, 25 is unprofitable, 26 is lining up the same way. Now things could change between here and harvest time, but generally right now it's looking unprofitable. Hog, cattle, chicken, so livestock farming is been doing quite well, frankly, across all three of those. So there's kind of a two-faced ag economy going on. Inflation has hit farming hard. Seeds and fertilization, right? Directly tied to energy. Corn and soybean prices continue to be too cheap to cover. I mean, they are getting less income than it takes to put the crop in the ground and get it harvested. 80 now on the farmland side, 84% of farmland is paid off in Iowa. Think about that. That number has been going up every year. When you talk about the average age of farmers, it's in the upper 60s and lower 70s. Okay. And banks now are interesting. They're kind of doing an extend and pretend, which means they're kind of telling their ag clients, like, look, if we need to adjust your payment this year so you can hang on for another year to try to get to better times, we're willing to do that. We don't really want to take your land back. We don't really want you to have a bad loan. So it's called extending and pretending. So we're extending the terms of the loan and hoping, I would say, that things get better in the future. Okay. Also, new ag equipment is way down. New ag equipment sales down 21% year over year. Combines down 53%. Think about a local employer called John Deere, right? Pretty tough. Okay. Got more real estate stuff. Farm and recreational real estate. Farmland was generally down 3% statewide. Rents were flat over the last year. High quality farmland is still selling for $14,000 an acre. Buyers are almost all farmers at this point, and the reason is because the money doesn't pencil out to be an investor in farmland. Okay. The yield that you get, not the crop yield, but the yield as far as income that you get from buying farmland is at 25-year low, which is 2%. Okay, you can get better at a bank with that. Recreational land market is still very strong with hunting, fishing, timber areas going from $4,000 to $9,000 an acre, primarily in southern Iowa. Okay, that's where most of the timber hunting ground is. Commercial real estate, it is improving, but it's still very tough in downtown Des Moines. Vacancy rate downtown is 14% of all square footage is vacant. Now that's down, and it's been coming down for several years now. It's down from 16% last year. There are aggressive conversions going on from downtown office to condos. So the idea is, hopefully, we can make these into living spots instead of vacant offices. There are rumblings about debt restructuring. For instance, there are properties across the street over here that are owned by a local real estate company, and we have heard over the last year or so that the bank didn't want to get these back. Right? What happens when an owner can't pay the debt is the bank says it's a bad loan, and then the bank takes them back. Well, bank doesn't want properties. So again, that extend and pretend. They said, hey, we don't want these. We don't want to do a bankruptcy. You guys keep them. We'll lower the payment. We'll work on some restructuring on our side. So there is that, it's not bad, but it's also not great. Okay. So there are some things going on commercially. Generally, there's bright spots. Suburbs have a less than 5% vacancy rate. So commercial buildings out in the suburbs are doing great. Okay, big tale of two different tales, right? The same city, downtown and suburbs. Another bright spot is data centers. And I got to tell you, they're doing a lot of construction right now. And I've said this in the past. I don't know the current numbers, but as of a year ago, there's 5 sites for Microsoft, right? Over those 5 sites across the Des Moines Metro, in 5 years, they will have 90 data centers on 5 sites. Currently, I think they have 25 of them built. And Microsoft says that we have already sold all the capacity in those 90 data centers to our clients for the future. So a lot of big building going on. You see it out in Meta, right, which is across the street from Bass Pro Shops out on I-80. You see it with Microsoft all around town. Apple has a huge one being built between Waukee and Adel here. And these are multi-year projects. All right, so that is it locally. How are we doing with time? It is 1 o'clock. All right. We will stay for those of you that need to go. We want to honor your time, but I do want to open it up for Q&A. What sort of questions? I'll probably just have time for just a few here.
I'd share an observation. My wife was in real estate earlier in her life, and we bought a townhouse about 10 years ago for $140,000. And so I asked her today, what's it worth? She said, well, at least 300,000. And she says, you can't buy anything for under 300,000.
I will tell you, you can't buy much for under 300,000. Probably have to go into the city of Des Moines and probably going to have put some elbow grease into something. But you can buy small houses in the 200s. What else? Questions? All right. So I want to thank you for a couple things. Number one, thank you for coming today. I hope you found this helpful. Hope you found it informative. If you have questions, please ask your advisor. Would love to have a conversation with you about this stuff. Thank you for choosing Compass. Thank you for inviting us into your lives to walk along the financial path with you. That is our life calling. So thank you for your referrals. That's how we continue to grow. And I want to wish you a wonderful second half of the year. It's going to be a good one. I am eternally positive, optimistic. We will figure this out, whatever constraint that we're facing. So have a wonderful day. Thank you for coming.